Are we on the brink of a major economic downturn that no one is talking about?
Experts like George Gammon, Nick Gurley from Reventure Consulting, and Jeff Snyder are sounding the alarm. These analysts provide critical insights into the current economic landscape.
We've compressed their hours of analysis into clear, actionable intelligence, saving you valuable time.
Up next, George Gammon explains why the data indicates things are worse than you think. Just a quick reminder, this content is for informational purposes only and should not be considered financial advice.
Today, we're dissecting George Gammon's latest analysis on the current economic climate and what he believes lies ahead.
Gammon's expertise in macroeconomics and real estate provides a unique perspective on market trends and potential investment strategies.
George brings a critical perspective, often challenging conventional wisdom in the financial world.
Let's explore his key arguments and predictions, providing context for investors.
George Gammon presents a sobering analysis suggesting the current economic indicators point towards potential financial instability.
His core argument revolves around the unsustainability of current debt levels, inflation, and the potential for significant market corrections.
George Gammon believes that interventions by central banks and governments may not be enough to prevent a severe economic downturn.
He emphasizes the importance of individual preparedness and strategic financial planning.
George Gammon expresses concerns about persistent inflation and its impact on purchasing power.
He highlights that government debt levels are unsustainable and could lead to further economic instability.
George Gammon points out how the Federal Reserve's policies may not be sufficient to curb inflation without causing a recession.
He also warns that rising interest rates could negatively impact real estate values and increase borrowing costs.
Gammon discusses the potential for a currency crisis if confidence in the U.S. dollar declines further.
He suggests that investors should consider alternative assets to hedge against currency devaluation.
George Gammon predicts a significant market downturn in the near future due to overvalued assets and economic imbalances.
He advises investors to reduce their exposure to equities and consider holding more cash or precious metals.
According to George Gammon, real estate prices could decline sharply if interest rates continue to rise and the economy weakens.
He suggests that potential buyers should exercise caution and avoid over-leveraging themselves.
George Gammon advises viewers to remain cautious and vigilant given the current state of the economy.
He emphasizes the importance of understanding macro trends and preparing for potential market downturns.
According to George, diversifying investments and holding liquid assets can provide a buffer against unexpected economic shocks.
Also, Gammon always stresses the importance of staying informed and adaptable to changing market conditions.
Today, we're reviewing Nick Gurley's analysis from Reventure Consulting on the cities most likely to see home price crashes in 2025.
Nick Gurley is the CEO of Reventure Consulting, a data-driven firm analyzing real estate trends and economic forecasts.
Nick uses macroeconomic data, demographic trends, and housing supply metrics to identify areas at high risk.
His approach combines quantitative analysis with on-the-ground insights to provide actionable advice.
Nick Gurley believes that several factors are converging to create a potentially unstable housing market in 2025.
His thesis emphasizes the interplay between supply, demand, and macroeconomic conditions.
According to Nick, shifts in demographic trends will play a crucial role in determining which cities face price declines.
Areas with declining populations and weak job markets are particularly vulnerable.
Nick Gurley points out that overbuilding in certain markets is creating a glut of inventory.
High levels of construction relative to demand can lead to price declines as builders compete for buyers.
Gurley notes that shifts in population, such as people moving away from expensive cities, impacts demand.
Areas experiencing net population loss are more likely to see price drops.
Are these cities typically in the Midwest or Northeast?
Yes, populations are generally shifting away from those areas and towards the South and Southeast.
Nick Gurley explains that rising interest rates increase the cost of mortgages, reducing affordability.
This can cool down demand and put downward pressure on prices.
Has the Fed indicated that they will keep rates steady?
Yes, but the market is pricing in one or two more hikes, which will put even more pressure on home prices.
Nick Gurley identifies specific cities like Austin, Phoenix, and Boise as being particularly vulnerable.
These areas have seen rapid price appreciation, followed by signs of slowing demand and increasing supply.
Why those cities in particular?
They've seen a big run-up in prices coupled with an increase in supply. That's a deadly mix.
Nick's analysis suggests that areas with high levels of investor activity are also at greater risk.
Investors are more likely to sell quickly in response to changing market conditions, exacerbating price declines.
So stay away from Airbnb locations.
That's right. Investors are quick to exit those markets, which will put pressure on prices.
Nick Gurley suggests that close monitoring of population shifts, job market data, and housing supply metrics is crucial.
Absolutely, understanding these factors can provide early warning signs of potential market corrections.
Nick's analysis shows areas with declining populations and weak job growth are most vulnerable.
And remember to focus on price action. If momentum turns, be prepared to sell.
Today, we're analyzing Jeff Snyder's commentary on how the price of a McDonald's Big Mac reflects broader economic challenges.
Jeff uses the Big Mac as an accessible indicator to highlight the struggles many consumers face due to inflation and economic pressures.
Jeff Snyder is a well-known economist, and he provides insights into macroeconomic trends.
Jeff focuses on the real-world implications of economic policies and market dynamics, making complex issues relatable.
Jeff Snyder uses the rising price of a McDonald's Big Mac to illustrate the growing economic pressures on consumers.
He argues that the increased cost of this simple meal is indicative of broader affordability issues.
Jeff believes that this seemingly small price increase reflects a significant shift in the economic landscape.
It demonstrates how inflation and economic policies are impacting everyday lives.
Jeff Snyder points out that the rising cost of a Big Mac symbolizes broader affordability issues for everyday consumers.
The increasing price means that a simple meal is becoming a financial strain for many.
It also shows the official inflation numbers do not align with the true cost of living.
Jeff's analysis indicates that the demand for budget-friendly options at places like McDonald's will increase as consumers seek cheaper alternatives.
This shift can lead to changes in consumer behavior and spending patterns.
So people will start to look for cheaper substitutes, like dollar stores.
Jeff Snyder believes that if people cut back on small pleasures like fast food, it's a sign that the economy is under significant pressure.
It means consumers are prioritizing essential expenses over discretionary spending.
And could be a sign of a real recession, so be careful.
Jeff Snyder suggests that continued pressure on consumer affordability could lead to reduced spending in other sectors.
This could affect retail sales, housing, and other areas, impacting overall economic growth.
Jeff notes that policymakers need to address the underlying factors contributing to inflation and economic inequality to prevent further strain on consumers.
Without effective solutions, the economy could face prolonged challenges.
Jeff Snyder suggests keeping an eye on consumer spending habits and the willingness to pay for discretionary items like fast food.
A decline in these areas might signal deeper economic issues than official statistics reflect.
Jeff emphasizes the importance of looking beyond headline inflation numbers and considering the real-world experiences of consumers.
Focus on the affordability of everyday items and services to gauge the true impact of economic policies.
Today, we're analyzing Gary Wagner's insights on gold's record-breaking rally and what could drive its next moves.
Gary Wagner's analysis combines technical and fundamental factors to give a comprehensive view of the gold market.
Wagner brings years of experience in analyzing precious metals markets.
Wagner's expertise makes his analysis particularly valuable for understanding the complex dynamics of gold.
Gary Wagner emphasizes the interplay between dollar strength, geopolitical events, and central bank policies.
Wagner believes that these factors collectively drive gold's price movements.
Wagner points out that gold serves as both a safe haven and an inflation hedge.
Wagner notes that its dual role makes gold a unique asset in times of economic uncertainty.
Gary Wagner highlights the inverse relationship between the dollar's strength and gold prices.
Wagner suggests a strong dollar typically pressures gold, while a weaker dollar supports it.
So, monitoring the dollar's performance is key to understanding potential gold price movements.
Wagner notes that geopolitical risks can significantly boost gold's safe haven appeal.
Wagner points out that events like wars or political instability tend to drive investors toward gold as a safe asset.
This means keeping an eye on global political events can provide insights into gold's potential upside.
Gary Wagner suggests watching central bank activities, particularly their impact on inflation and interest rates.
Wagner believes that changes in monetary policy can significantly influence gold's attractiveness as an investment.
Essentially, shifts in central bank policies can act as major catalysts for gold price fluctuations.
Wagner mentions that inflation rates also play a crucial role in gold's performance.
Wagner notes that as a hedge against inflation, gold tends to perform well when inflation is high.
This means monitoring inflation data can provide clues about gold's potential as an inflation hedge.
Gary Wagner suggests focusing on geopolitical risks, as these events tend to drive safe haven demand for gold.
Right, geopolitical instability often leads investors to seek the safety of gold, pushing its price higher.
Wagner points out that the dollar's strength can impact gold prices, so it is crucial to watch dollar movements.
A stronger dollar can suppress gold prices, while a weaker dollar may support them.
Today, we are recapping Cathie Wood's big ideas for 2025.
Cathie Wood, the founder and CEO of ARK Invest, is known for her optimistic views on disruptive technologies.
Why is it important to follow Cathie Wood's insights?
Cathie Wood has a track record of identifying high-growth potential in emerging industries. Her annual Big Ideas presentation is highly anticipated.
What's the overall theme of this year's Big Ideas?
Cathie Wood is focusing on transformative technologies that could generate significant returns. Areas like artificial intelligence, genomics, and blockchain are front and center.
What's the central theme of Cathie Wood's investment strategy?
Cathie Wood's core thesis is that disruptive innovation drives long-term growth. Investing in these technologies can yield significant returns.
Why is she so focused on these areas?
Cathie Wood believes these technologies are on the cusp of transforming industries and creating new markets.
What are Cathie Wood's views on genomic sequencing?
Cathie Wood is very bullish on genomics. She highlights how the cost of sequencing a human genome has fallen dramatically, making personalized medicine more accessible.
What does she see as the potential impact?
Cathie believes genomic sequencing will revolutionize healthcare. Early disease detection and personalized treatments are the future.
Let's talk about autonomous technology. What's Cathie Wood's take?
Cathie Wood sees autonomous technology as a huge growth opportunity, from self-driving cars to automated delivery systems.
What are some specific examples she discusses?
Cathie Wood emphasizes the potential for autonomous vehicles to disrupt transportation. She also talks about robotics transforming manufacturing and logistics.
What does Cathie Wood say about blockchain technology?
Cathie Wood is a big proponent of blockchain technology. She believes it's more than just cryptocurrencies. It's a foundation for decentralized finance and new internet applications.
Can you elaborate on the potential applications?
Cathie Wood highlights blockchain's potential in areas like smart contracts, supply chain management, and digital identity. She thinks it will revolutionize how we interact with the internet.
What are Cathie Wood's predictions for energy storage solutions?
Cathie Wood predicts that energy storage costs will continue to decline, making renewable energy sources more competitive.
What does this mean for the energy market?
Cathie Wood sees energy storage as essential for widespread adoption of renewable energy. Electric vehicles and grid-scale storage will grow exponentially.
What does Cathie Wood expect from artificial intelligence?
Cathie Wood is extremely optimistic about artificial intelligence. She expects AI to transform every industry, from healthcare to finance.
Any specific AI trends she's watching?
Cathie Wood is closely monitoring advancements in machine learning, natural language processing, and computer vision. She believes these technologies will unlock new levels of automation and innovation.
So what are the main lessons from Cathie Wood's big ideas for 2025?
Cathie Wood emphasizes the importance of investing in disruptive innovation. She believes these technologies will reshape industries.
Any specific sectors or technologies Cathie highlights to watch closely?
Cathie points to robotics, energy storage, AI, DNA sequencing, and blockchain technology as key areas to focus on.
What action steps should viewers take based on these big ideas?
Cathie Wood suggests doing your homework, understanding the risks and potential rewards, and staying informed about advancements in these fields.
Wow, what an enlightening discussion with such diverse views.
I know, right? Cathie Wood championed innovation while Gary Wagner really dug into the importance of gold as a hedge.
And then we had Jeff Snyder, who brought a whole new layer by stressing the long-run effects of monetary policy.
Plus, don't forget Nick Gurley's insights on real estate, very underrated in the current market.
Absolutely. It's clear these experts agree on the volatility out there, but their paths to navigate it diverge.
Yes, and that disagreement between Cathie's innovation-first approach and Gary's gold focus was particularly striking.
If you're tuning in, you've gleaned some powerful strategies from these financial masterminds.
Don't keep that knowledge to yourself. Hit that like button and subscribe for more insightful content.
Join us again for our next session, where we'll continue to unravel the intricacies of our financial world.
Your support is vital in helping us bring you these amazing discussions.